You open the envelope slowly. The return address says Department of the Treasury. Your stomach drops before you even read the first line. It is an audit notice. The IRS wants documentation. Receipts, bank statements, proof you are who you say you are on paper. Millions of Americans get this letter every year. For most of them, it is the most stressful piece of mail they will ever handle. Here is what you almost certainly do not know. While you are scrambling for receipts, some of the largest corporations in the country have something you do not. A guarantee written into a legally binding agreement, filed with the federal government, that the IRS will not come looking again. Not a lower audit rate. Not a delayed review, a contractual promise that the examination is over. Permanently for the covered issues. Done. The IRS has been shrinking for years. By 2018, its workforce had fallen to 7,500 employees, the lowest level since the 1970s. Between 2010 and 2019, the audit rate for taxpayers earning over $1 million dropped 62%. According to data tracked by the Transactional Records Access Clearinghouse at Syracuse University. Charles Rettig, the IRS commissioner, told the Senate Finance Committee in April 2021 that the steepest audit declines hit the highest income taxpayers first. The agency ran out of the specialists needed to audit complex corporate returns, so it stopped trying as hard. But there is a category of settlement that goes further than simply not being audited. It removes the IRS's legal right to look at all. The mechanism is buried inside a specific type of agreement, a clause most Americans have never heard of. By the end of this video, you will know the exact name of that clause, pulled from a publicly filed document, and why tax lawyers across the country are already studying it to get the same deal for their own clients. This is about more than one company. This is about who the tax system is actually built to protect. Here is the easy explanation. Big companies settle tax disputes with the IRS all the time. It happens constantly, quietly, in conference rooms with no press release and no fanfare. That is just how the system works. The IRS is not a courtroom. It is a negotiating table. When the agency identifies a discrepancy, a transfer pricing arrangement, a foreign subsidiary structure, a deduction that looks aggressive, it does not immediately sue. It opens a dialogue, both sides present their numbers. Lawyers talk to lawyers, eventually. A number lands on the table, and both sides sign. These agreements have a formal name. Under Section 7121 of the Internal Revenue Code, the IRS can execute what is called a closing agreement. It is a binding contract. The taxpayer pays a settled amount. The IRS acknowledges the matter is resolved. The file gets stamped closed. Caterpillar Inc. reached one of these agreements in 2024. The number was $1,776 million. That is not a rounding error. That is the kind of settlement that fills a press release and gets cited in earnings calls. On its face, the story writes itself. Large corporation, aggressive tax structure. IRS pushes back. Company pays up, everyone moves on. Case closed, system working as intended. Except, one specific clause in that agreement does not appear in standard closing agreements. A clause that, according to MarketWatch's reporting on the settlement terms, bars the IRS from examining Caterpillar's books on the covered issues going forward. Not just for that year. Not just for the years under dispute. A normal settlement closes the past. This one also closes the future. That is not standard. A standard closing agreement resolves what happened. It does not contractually remove the government's right to look again. So if this was just a normal settlement, the kind that happens every quarter, in every industry with no particular significance, why does a normal settlement not include a promise to never look again? Here is where the story changes. Not because of what the IRS did, because of what it agreed it would never do again. Buried inside certain tax settlements is a clause most people have never heard of. It comes from Section 7121 of the Internal Revenue Code. A closing agreement, the IRS and a taxpayer sign it. A senior IRS official countersigns. And from that moment, the agreement is final, conclusive, and legally binding on both parties. Forever. That word matters, forever. A standard closing agreement resolves a dispute about the past. Money owed, penalties assessed, years examined. All of it closed, tax agencies settle disputes constantly. Nothing unusual there. What makes certain closing agreements different is the scope of what gets locked shut. Not just what happened, what the IRS is permitted to examine next. The Internal Revenue Code grants the IRS broad examination authority. It is the legal backbone of voluntary compliance. The assumption baked into the entire system is that any taxpayer any year, any covered transaction remains subject to review. That assumption is what makes the tax code function. Remove it for one party, and you have not just settled a dispute. You have rewritten the rules for that party specifically. That is not a conspiracy theory. It is a reading of the statute. Tax court procedural records confirm these agreements carry full legal force. Courts have upheld them. The IRS itself cannot unilaterally reopen a matter a closing agreement has resolved. The agency's own hands are bound. So here is the question that should stop you cold. If the IRS can contractually limit its own future enforcement power for one taxpayer, what does that do to the foundational principle that tax law applies equally to everyone? The mechanism is legal, it has been used. The receipts exist. The real question is not whether this happened. It is who else has access to this door and who never even knew it existed. Here is the thing nobody wanted to say out loud. The IRS that agreed to stop looking was already barely looking. Between 2010 and 2019, the IRS budget was cut, year after year, in ways that forced real triage decisions. By 2018, the agency's workforce had fallen to 73,500 employees, the lowest level since the 1970s. Fewer agents, longer queues, older systems. Something had to give. What gave was enforcement on the wealthy. The IRS Data Book documents it in plain numbers. In 2010, the audit rate for taxpayers earning over $1 million was 8.4% by 2019. That rate had fallen to 3.2%. That is a 62% collapse in scrutiny at the top of the income ladder. Charles Rettig, then IRS Commissioner, testified to the Senate Finance Committee in April 2021 that audit rates had dropped across the board. But the decline, he said, was steepest for taxpayers with incomes above $1 million. That is not an accusation. That is the math. But the numbers turn genuinely strange when you look at the opposite end of the income scale. While high-income audit rates were collapsing, something else was happening. According to Track IRS data and the National Taxpayer Advocates reports. In 2019, recipients of the Earned Income Tax Credit, workers typically earning under $20,000 a year, faced audit rates that exceeded those for taxpayers earning between $200,000 and $500,000. A 1.4% audit rate for a family claiming a $3,000 credit. A 0.4% rate for a filer earning 10 times as much. The National Taxpayer Advocates' 2019 annual report to Congress put it directly. The IRS's ability to ensure compliance with the tax laws has been significantly hampered by years of budget cuts and staffing reductions. An agency under pressure makes choices. The data shows who absorbed those choices. So the IRS was already stretched thin when it entered that settlement room. if the agency had to choose who to examine. And it did, what exactly was it agreeing to give up? Here is the clause, IRC Section 7121. A closing agreement, binding on both parties. Permanent. When the IRS settled with Caterpillar Inc. for $776 billion, it did not just collect a check. It signed away its right to look again. The covered issues became permanently off the table. The offshore profit structures, the Swiss subsidiary arrangements, the years of disputed returns. What the IRS cannot audit, it can never collect. That is not speculation. That is what a Section 7121 closing agreement does. By law. Tax lawyers noticed immediately a settlement of this size, with this clause, is now sitting in conference rooms across the country. Not as a cautionary tale, as a template. The $776 billion may not be the number that matters. The clause is the number that matters. No future IRS examiner, no future administration, no future enforcement push can reopen those books. The payment bought finality, and finality, in tax law, is worth more than any single check. Hold that thought against one other number. In 2019, according to Track IRS data and the National Taxpayer Advocate's annual report to Congress, the IRS audited earned income tax credit claimants at a higher rate than taxpayers earning between $200,000 and $500,000, people earning under $20,000, a single mother claiming $3,000 credit faced longer odds of being left alone than a six-figure earner. The National Taxpayer Advocate's 2019 report said it plainly. The IRS's ability to ensure compliance had been, quote, significantly hampered by years of budget cuts and staffing reductions. This is not a conspiracy. It is a triage decision made by an agency that lost a third of its workforce between 2010 and 2018. When you are understaffed, you audit what is cheap to audit. IRS cases are straightforward, multinational profit shifting is not. Remember the envelope from the beginning of this video. The one that made your stomach drop. That letter exists because the IRS had the budget to send it to you. The closing agreement exists because one company had the resources to negotiate what came next. The Inflation Reduction Act gave the IRS $80 billion over 10 years. IRS Commissioner Danny Werfel's 2023 Strategic Operating Plan explicitly targets high-income and corporate enforcement. Whether that changes the math on who gets the letter and who gets the clause is the only question left worth asking. Subscribe, a new breakdown like this every day.